Welcome to the GSX podcast, where we explore the evolving landscape of commodities, trading, and alternative capital. Hosted by me, Henry Walsh, and the team at Great Southern Cross Commodities, the podcast brings together market participants, managers, and investors to discuss how capital, policy, and innovation are reshaping the global commodity markets. From carbon to coffee, energy to macro, we cover the full commodity investment universe, unpacking the trends, risks, and opportunities that matter. Please note, the views and opinions expressed on the GSX podcast are those of the hosts and guests and do not necessarily reflect the views of Great Southern Cross Commodities or its affiliates. This podcast is for informational purposes only and should not be considered as financial, investment, or trading advice. Listeners should conduct their own research or consult a professional advisor before making any financial decisions. Hi, my name's Henry Walsh and welcome to the GSX podcast. This week we have a very special guest, Mr. Mike Coleman, who is based in Singapore. I'll let Mike give you a history of his esteemed record and background, but Mike's been in commodity markets for longer than most of us, whether it's in trade houses, hedge funds, or other private investments. Mike and I have known each other for a long time, from my time in Singapore, and he has always been a useful mentor to me over my career. So welcome aboard, Mike.
Thank you, Henry, and thank you for those kind words. Yeah, so as Henry was saying, I've been in commodities now for what seems an unbelievably long period of time as I look back. But I started working for Cargill in the UK in September 1982, just after I graduated from college. So that's over 43 years ago. And somewhat unusually, I joined Cargill, or I accepted the job offer in the spring of 1982, just before I graduated, expecting to be a grain trader. Over the course of that summer, Cargill had done some reorganizing of its commodity businesses in Europe, and had also bought some soft commodity trading businesses. And so it so happened that my first posting was to Cargill's new natural rubber business that had a London office, an office in Singapore, New York, and Kuala Lumpur. 18 months later, they asked me would I like to go to Singapore for a couple of years, and the rest is history, as they say. So I arrived in Singapore in October 1984, ended up running Cargill's global rubber business in the early 90s. In the late 90s, I also took responsibility for Cargill's petroleum trading in Asia. Then in the early 2000s, Cargill went through one of its periodic restructurings at times of low prices. So for those of you who are old enough to remember, the late 90s were a particularly horrible time for commodity markets. Brent got down towards $6 or $7 a barrel as the Saudis tried to break OPEC or discipline OPEC, I guess is the better word. In the late 90s, you had the long-term capital management crisis, you had the Asian crisis, commodity prices were pretty depressed. And so I left Cargill actually in 2001 and went to work with Marubeni for a couple of years, doing some for a Japanese trade house. They were interested in some of the less traditional things we've been doing at Cargill. And one of the ideas that have been percolating away amongst some of us at Cargill have been the idea of is there a proposition to do a commodity hedge fund sitting across the different commodity verticals as a better way to leverage the information flow that each of those verticals is generating and creating the ability to bring in external money, paying fees. And so to monetize that information, if you like, more effectively than the individual businesses were doing individually. Marubeni quite liked the idea, but asked me to go validate it by finding some third-party capital, which I duly did. And in a Swiss family office called Parley, the CIO of Parley was a Canadian gentleman called Peter Fletcher, who had created a hedge fund seeding business for Parley, amongst other things, and was particularly interested in, the China boom was just beginning to get going, and he wanted different ways to get exposure to commodity markets. And so he liked the idea of a commodity long short fundamental based strategy. Finally persuaded the family, together with another family, to put up $10 million to seed us. And so we kicked off the Merchant Commodity Fund in the summer of 2004. Marubeni, though, decided that it was too risky reputationally to be involved with the startup hedge fund. And so Tokyo went to my boss and said, no, it's not the right time, wait another year maybe. I said, well, the money's here right now. Don't know if the opportunity will be there the other year. And the Swiss Family Office, Peter Fletcher, said to me, actually, we're betting on you, not on Marubeni. If you think you can do this strategy on your own, we're there with the seed money. I took the decision at that point to give up my day job. I reached out to a former Cargill colleague who I've worked directly with in the petroleum business in the late 90s, Doug King, who I knew wanted to be in the hedge fund space, was looking for the right opportunity. And I said, "You want to come and play, Doug? We've got $10 and there'll be no salary. We're going to be living off performance fees for a while." And Doug said yes, and we kicked off the Merchant Commodity Fund in June 2004. So that's probably a bit longer introduction than you wanted, but that's the
No,
story. That's the story in a nutshell.
no, it's very interesting.
Mm.
In terms of commodity funds at that time, I mean, there wasn't
No, there weren't a lot.
a lot around, right?
No, and that we ended up being in the right place at the right time because of that. So there were Dwight Anderson with Osprey was running. I think John Arnold and Centaurus was up and running in the US. There were a few older CTA type operations, Vim Koiko with Blenheim, but there wasn't a lot of choice, and most of those guys were full.
Yeah.
And so what actually accelerated us, so we started with $10, as I was saying, and it took first 18 months, we were developing a good track record, but money was understandably a bit slow to come because with a new hedge fund, people are watching and waiting. And what really, there were several things that led to us. We made our breakthrough late '05. And there were a couple of things came together at the same time. So firstly, a lot of the money that was going into commodities at that period was going into commodity index. And far and away, the Goldman Sachs commodity index was the biggest index. And AIG and Goldman Sachs had been busy marketing to pension funds and so on about why you needed commodities, why there was they resurrected Keynes's theory of normal backwardation from the 1920s. And the index was very heavy energy, so it was about 75%, I think, mostly crude oil and petroleum products. And of course, the crude oil market had been backward for most of the 80s and 90s, but again, it's a great example of the fallacy of the back test. The crude oil market was inverted because OPEC made it so. It wasn't naturally inverted. It was an artificial inversion that had been kept going since the late 90s. So, OPEC Saudis had disciplined OPEC in the late 90s, brought everybody to heel, and then have been explicitly running the market in the early 2000s to keep a backwardation in the front of the market. So a lot of investors were in passive index, expecting to be earning positive roll yield as the biggest markets were backwardated and were expected to stay backwardated. And then in the second half of 2005, you ended up with a situation where the Saudis sort of gave up on controlling the backwardation. Crude oil production began to rise, and you actually had the beginning of the shale revolution in America. And at the same time, you also had the ethylene boom for corn. So you had a situation in the second half of '05 where the ag markets were booming, driven by corn on the ethanol story, and the crude oil markets were weak and flipped from moderate backwardation to quite a steep contango. And so by the end of '05, the index investors had just had a shocker of a year that they weren't quite understanding. How can this be? Crude oil's only down a couple of percent. Other commodities are quite strong, yet we've lost 10, 15%. What's going on? And of course, it was the roll yield had turned quite negative. And so we had a very good year. I think we made, I think 35 or 36%, essentially from being short petroleum, long grains. And so we benefit. So we've got strong performance, and you've got investor disenchantment with index. And what really accelerated us was actually global asset management. So global asset management had a series of trading funds, GAM trading, one, two, three, and they've been very instrumental and have benefited from guys like Bruce Kovner at Caxton and Paul Tudor Jones. And by 2005, those guys were all full, and GAM was launching GAM Trading 4. And so it was looking for commodity managers, CTAs, to populate GAM Trading 4. And so we we finished '05 at about $35 million. And GAM came to us in December '05 and said, can you take 100?
There you
And
go.
we said, let us think about it for about, well, no, there were two
Conditions.
concerns. Firstly, the board said, so, Peter Fletcher, there was another very experienced commodity guy, Hans Willem van Tool, who'd been at Cargill and then at Cargill Investor Services, and was very active in the Managed Futures Association and AIMA, sort of hedge fund governance. And Peter and Hans Willem said to us, yeah, that's great, but do you really want 80% of your assets with one, will they be too big as a percentage of your assets? And we said, well, we'll deal with that problem, and hopefully there will be the catalyst to bring other people in. And the second thing was internally, we said, theoretically, we know we can handle it. Futures are very scalable, but let's, make sure that our systems and processes that we're comfortable with that. Because at that time, one of the first questions people ask you as you're launching a hedge fund is, what do you think your capacity is? And back in sort of 2004, 300 million was a big fund in Asia. So it was the sort of natural size that an Asian long short equity fund could get to without being too big for a market that, a lot of places you couldn't short equities and so on. So 300 million was a big fund in Asia at that time. So when we started, we said to people, well, we'll soft close at 300 and then see how it goes. So anyhow, with GAM came in, we said, give us the money over 3 months so that we can stress test our back office. And we actually went out and hired a sort of experienced admin manager, because we hadn't had a budget to hire an experienced admin manager until that point in time. And then the GAM money came in, and that got the hockey stick going, or the snowball rolling. So there've been lots of people who've been watching us. Benefits of having somebody like Peter Fletcher and Hans Willem both on the cap table and on the board of directors was that we got a lot of soft marketing. Our name got mentioned whenever they were meeting people. So we had a lot of meetings from people were called by to see us, who in the normal course of events wouldn't have bothered seeing a 12-month-old Singapore commodity fund with just 15, $20 under management. So we had a lot of traffic. I was taking every opportunity, whenever CNBC or Bloomberg phoned up wanting somebody to comment on commodity markets, I'd be very happy to be in front of the camera and pontificating on stuff that I didn't actually know a lot about it. For instance, when there was a big scandal in the petroleum oil market in, I think it was probably mid 2005, China Aviation Oil. So it was the Chinese state-owned company that was in charge of buying jet fuel, and they set up a Singapore office. And of course, the guy they'd sent to run the book got carried away with being in Singapore and being courted by all the brokers and investment banks, and he built up a massive position, and it all went pop. And I think I was the only person willing to go on TV, even though I was no longer in the physical oil business, but I did know the people involved. And so I was very happy to go on TV to give my view on what had gone wrong at China Oil Aviation and China Aviation. Today you'd say it's sort of guerrilla marketing or soft marketing. We had no marketing budget, but so anyhow, there we are with people can see AUM coming in. We said to people, we are going to soft close when we get to $300. We got to $300 in a couple of months. And we did soft close, and we stayed closed until, so this is mid '06, and then we stayed closed till early '07 when we reopened to go to $1 billion. And we went to $1 billion on that one opening, and we closed again. And then we reopened in early 2008 to go to $2 billion, and we closed in a month to go to $2 billion. Incredible looking back on it now, but it was this. We were really fortunate. So
the timing was great,
as it turned out. So as most people, if you spend any time in the hedge fund industry, you'll know that great performance is necessary but not sufficient for a startup fund. And so we were really fortunate to have found that really sweet spot where commodities were hot. Investors were looking for more sophisticated. So up until that point, as I said earlier, most of the money was in passive index had raised a lot of money. Traditional CTAs were getting a lot of flow, and we were offering something very different. So although we look like a CTA because we express our positions mostly in futures, a little bit of options, the way we were non-systematic, completely discretionary, bottom-up fundamental. And so it was a very different flavor to what was generally available in the market at that time. Well, it's really funny looking back on it. Originally, the fund should have started in late '03, and then things got held up because Marabini didn't want to do it. Had to, went out, got Doug involved, so on. And so we actually started in May '05. Crude oil had reached $50 a barrel. And we said, God damn it, we've missed the biggest crude oil bull market since the Gulf War. It's going to be a grind from here. How unlucky are we? God damn it. Because growing up in the '80s and '90s, your experience, there hadn't been a secular commodity bull market since the late '70s. The few bull markets we'd had in '84, '85, '87, '88, 94, 95 have been 18-month affairs, and it was more cyclical, bit of demand increase, and then it fades a bit and the production catches up. And also China had been opening its economy, but it was coming from a low base. And during the 1990s, Chinese commodity demand was very irregular. So basically, they'd come in and they'd massively overbuy, and then they'd disappear from the market for 18 months while they digested what they'd bought. And so, in 2003, you'd seen a big surge in China buying in 2002, 2003. But everybody's expectation was that it'd be just like the '90s and it was going to disappear again. And so we were like, it's going to be tough, blah, blah, blah. We're not going to have any big themes to trade around. Fortunately, we were wrong that the China boom had legs, and we had the first secular bull market since the late '70s. That helped us build a performance that attracted the money and so on and so forth.
So I think it'd be interesting to take a pause there. So I just think if you look over the last, say, the 20 years before 2005, and then since 2005, which is 20 years ago, sort of split that up. Not in terms of investors or your business, but in terms of how you would approach commodities and where the edge was. Because I think up until, the internet was late '90s, but it really took off in markets in the early 2000s in terms of, executing electronically, data became accessible much faster. And then how did you adapt? How was it, say, pre-2005? And then, to 2005 to 2015, I think there was, generally fundamentally kind of worked. And then post 15, it's been probably the last 10 years have been different again.
Different. No, so the '80s and '90s were the sort of wilderness years, if you like, in commodities. So you'd had the big boom in the in the '70s, culminating with, gold reaching $800 an ounce on New Year's Day, 1980. But by the time I started work in 1982, these were well and truly in a bust. All the, the big boom of the late 70s, you'd seen deep water oil, the North Sea for Mexico had all come to market. In my sort of core rubber world, Thailand had a big replanting program financed by the World Bank that all those trees came on stream in 1982, 83. So generally, commodity markets had to deal with the bust after the boom and structural oversupply, which is a very tough market for physical commodity traders. In an oversupplied market, firstly, the flat price tends to be pulled down onto the cost of production, which means the price is low. And secondly, margins get compressed and volatility gets compressed. So trading earnings become very difficult to make. I guess at that period in time, you still had somewhat of an information advantage of being a big commodity house. That, as you were quite rightly saying, there was no internet. So one of the jobs, so when you started work as a junior trader on the desk, one of my jobs was to take the Reuters ticker tape and cut it off and put it on a clipboard for the traders to read the stories. Cargill had a real competitive advantage in that Cargill had an internal telex network. So Cargill had, 100 offices scattered around all the important producing and consuming regions. And so Cargill's in-house intelligence was better than what was Reuters was telling you. And so that gave you an edge, not in the rubber market, but certainly for Cargill's grain traders, they had a real, measurable advantage on trading basis, that they would know what the physical conditions were in Brazil, in the Midwest, maybe 12 hours before Reuters would be breaking the story. But that was already, I think that's been one of the big secular trends in commodities throughout modern history, is the commoditization of information and the erosion of the edge of the middleman.
Yeah.
And, that's just been a constant progression. I think it was sort of hyper accelerated with the advent of the internet. But already by the time I started work, and again, rubber as an example, there were maybe 20 rubber trading houses, fairly small businesses, mostly in let's say London and the ARA. So there were still a couple of Dutch colonial origin houses, a couple of French, 3 or 4 German, 15 London-based companies. That was about half of what there had been. So there'd already been a major winnowing as the boom of the 70s turned to the bust of the 80s. So, people like Zarnico, who had been in rubber, had closed their rubber department to focus just on sugar. Other companies had just, as the partners had got old, they cashed out their money from the 70s boom and decided it was too much like hard work to compete in this increasingly tough environments. So you were seeing this, the big guys like Cargill were getting bigger, the smaller regional fob to sift traders were finding life becoming more difficult. That process was underway. Technology-wise, the only screen on the desk in London was a direct feed from the London futures market, the London Commodity Exchange. There was like a cathode ray green screen that showed in our case, we had the bid and offer for the London rubber futures market, which was still in existence in 1982. But no other, P&L was still calculated by hand each day. Again, another job for the junior merchant, that you would, write your position and where you bought, where you sold, what the current mark was, which was all actually fantastic training for ultimately doing a hedge fund. So yeah, so it was a different world. For instance, we'd go to the pub the London, the futures market would open from, I think it was 10 till 12:30, and then reopen at 4 or 3 or something. So we would have a minimum 2-pint lunch every day. So
Yeah.
a different world in that respect. From a sort of opportunity trading P&L point of view, a really tough 20 years certainly for the ags and the softs traders. Structurally
Yeah.
oversupplied markets, contango markets, generally the price spending, as I say, the price, every so often the price would have a 1 year, maximum 1.5 year bull market, and then you'd have a 1.5 year bear market and a 3 year bottom moving sideways with more people going out the business. I always like to say, had I been in London so Big Bang happened in the financial markets in, I think, 1986. And if I'd been in London, almost certainly I'd have gone to be a bond or a equity trader. So when they deregulated the London financial markets, the old system in London was very segregated. So you had stockbrokers who dealt with the buy side and the sell side, and then you had stock jobbers who were the market makers. But only a stockbroker could talk to a stock jobber.
Okay.
So you had, 12 specialist stock jobbers who were private partnerships, unlimited liability, and a host of stockbrokers. Big Bang happened, and so they allowed the integration of prop trading with brokerage. And so there was this huge feeding frenzy where all the big investment banks bought the stock jobbers and bought the stock brokers. But there was an absolute shortage of people with experience of running a book. And so where did they go for that experience? They actually went to the commodity markets and the FX market.
Interesting.
And so there was a massive flow of, at the end of the day, talent follows the money, if you like.
Definitely. Yeah.
And you were at the beginning of, the massive bond and equity bull market of the 90s and 2000s. And so, there was a big exodus of people out of the commodity markets to the financial markets. And then there were stubborn guys like me. I was actually, because I was on a expat contract in Singapore and was getting a lot of responsibility at a young age, I stuck with it. So another important thing, when the commodity boom of the early 2000s began, there was a shortage of experienced commodity traders.
Yeah.
And we used to joke, we're like flared trousers, you wait 20 years and suddenly you're in fashion again. But that was a real capacity constraint. That was a real moat for our business, was that there were actually, to credibly be able to do our strategy, you had to have, let's say, at least 10 years experience in the physical markets to be able to access the information and have the network of channel contacts. And there was just how many mid 30, and the answer was relative to the number of, how many FX traders are there, how many bond traders are there, how many equity guys are there. The commodity pool was very small, and so we definitely benefited from that.
Yeah.
So that world was a very, and what had happened was, and again, it's the fallacy of the back test, as the passive indexes found out, was that commodities were completely uncorrelated with equities during the 80s and 90s because nobody was looking at the commodity market. So commodity markets had gone from being an important marketplace to being very much a sideline. Nobody was paying attention, so they weren't in people's portfolios. And so, for instance, when Black Monday in 1987, Grey Friday, happened to be the weekend I got married. I got married on Grey Friday and was away on my honeymoon in New Zealand with no phone or internet connectivity and blissful unawareness. My brother and a group of friends who traveled to Singapore for our wedding were sat in Singapore wondering, did they have a job, because they were mostly in the equity markets, did they have a job to go back to? And was their house still there? Because they actually had a hurricane that same weekend that hit the south of England. Like, it was the worst storm in 200 years. Roofs were blowing off, trees were falling. So they said, we all had this like gallows. It was like a scene from the Bogart film Key Largo. We're all sat in this bar in Singapore, and it was the monsoon was beginning in Singapore, so it was raining in Singapore. We're drinking our drinks, wondering, do we have a job and do we have a thing? But the bigger picture was the commodity markets looked at the equity markets more as disinterested spectators about, well, this is exciting. We've not seen this since 1929, but it didn't actually, there was no like big fall. Commodity markets did not go multi-day limit down or anything. It was very much, this is our commodity world. Doesn't have a lot to do with the world of financial assets, and plow on.
Yeah. And
You
so,
can you can
yeah.
contrast that very vividly with what happened in 08, 09.
Yeah. Well, the correlation went to one, right?
The
With
correlation
everything.
went to one, which was a great learning lesson for us, actually. So to come back to your original thing, so the first 20 years, structural bear market in a world where commodities were not very correlated with other investment classes and were the most underinvested that they'd been in 100 years. But, you'd had this, commodity markets were big markets relative to equity markets until, let's say, the 19 and then the equity markets had obviously gotten to be much bigger and so on. So the 80s and 90s were the wilderness years for with the exception of the petroleum markets, because the petroleum markets paradoxically were new markets and huge markets. And so again, a lot of commodity talent went to the petroleum markets as well. So the grains and soft markets saw a shrinkage, if you like, of talent. And that was very different as 04, 05, as it became apparent that the China boom was booming and it was multi-year, money started flooding back into commodities. And by this time, yes, the informational edge was becoming much more commoditized.
But would you say do you think that was offset to a certain extent by, I remember that period well, that there was a lot of, I guess, people that could make money when the markets went up, but not very good at making
No,
money
no,
when
no,
the
no.
market went down.
So
So it's
there
sort of like
were,
a money flow was
so there were
different.
a lot of tourists came into the market, as always happens. So every year I used to ask my brokers, you know, seen anything interesting? We notice this flow's happening or that flow's happening. I always remember in '07. So, China's booming, commodities are going up, a lot of money flowing into commodities. And I'm talking to my brokers. I said, where's all this new money coming from? Is it mostly traditional CTAs and indexes getting all the money? They said, yeah, to some extent, but also we got lots of equity funds, buying copper because they can't buy Chinese equities. And they view that being long copper is a good play on the Chinese equity market. I said, okay, well, that's probably not going to end well. And indeed, it didn't. 2009, I think it was, French bank SocGen showed me a variance swap for crude oil. And so I said, well, theoretically, I know what a variance swap is. And in my Cargill days, used to talk to the guys in the financial markets group and, variance swaps and so on. I said, but, to fix the strike on a variance swap, you've got an equation that's about this long.
Yeah.
I said, I can't imagine that it's oil traders trading variance swaps with each other. And the French guy at SocGen goes, well, maybe. It's mostly as investment banks trading variance swaps with each other. And also, the equity guys have noticed that commodity volatility is a lot cheaper than equity volatility. So they're buying a lot of oil vol to hedge themselves against equity. And I said, that sounds a bit risky. But it's true. And actually, that's been a structural change. So normally, as you know, Henry, in commodity markets, the skew is to the call. So your big
Yeah.
risk in the commodity market is that you run out of supply, that you have some supply interruption, a crop disaster, and the market spikes to the upside, which is the mirror opposite of equities, where your problem in equities is nobody has to buy equities, and therefore the volatility and the skew is to the put. Since 2009, the crude oil skew has been to the put.
Yeah.
So
Well, I think
So the influx of financial players into the commodity space has been significant enough to change the skew in the oil markets. Less so in the other market. I think the skew is still generally to the upside in the softs and ags, but certainly in crude oil it changed the skew. So 2008 was a really great 2008, 2009. We learned a lot of lessons about how correlated commodity markets had become to financial markets. and how you couldn't afford to be a fundamentalist. So coming from our background and typically commodity traders coming out of the commodity houses are quite arrogant, if you like, about it's all about the fundamentals. We know the fundamentals. Systematic is voodoo, completely spurious science. Forget about that. And, you need decades of experience and huge numbers of contacts to really be able to understand the fundamentals because there's not enough info in the market. Unless you can talk to a farmer in Brazil, you don't really know what the basis is. And therefore, we're right and they're wrong.
Yeah.
If this market's going up and we think it's going down, we're going to lean into it and we'll be right in the end. So big learning moment for us. So there were several. First one was Bear Stearns. So in the first beginning of '08, there was a big problem with the soybean crop in Brazil. Looked like it was going to be a low crop. China had bought huge amounts. The world was going to run out of beans. Price of beans starts running up. So by this time, we're a $2 billion fund. We have a very big bean position, 20,000 contracts in Chicago.
Jesus.
And we are as bullish as we've ever been. We're going is like, there is no way out of this. China's just going to have to pay up. And, we don't know where the top is. There's nothing magical. We're at 17. There's nothing magical about 17. Why not 18? Why not 19? Why not 20? March is the month where the fundamentals hit where it all has to play out. So we go into March, we have a fantastic start to, I think our best ever month until quite recently was February '08, and we're up like 20% the end of February on a $2 billion fund. March starts quite well. God's in his heaven. We, of course, are saying, we've not seen the top yet. We don't know where the top is. Bear Stearns blows up, and we find out that actually there is a lot of financial money in this soybean market.
Yeah.
And beans go limit down, I think, 3 days in a row. We also have on a bean wheat spread because the wheat supply demand was actually really crap, and we figured that they'd be switching wheat acres. So anyhow, so our short hedge in the ag space is we are short wheat, and in our commodity trading, the wheat short, if the market sells off, the wheat short's gonna, that's the dog. That's gonna get hit much harder than the beans, and therefore we're gonna be protected by the corn, by the wheat bean spread. And of course, what we get is an equity market risk off scenario. The good stuff gets sold and the bad stuff gets short. So we get double whammied on our short goes limit up, our longs go triple limit down. I think we ended up the month down 16%.
Jeez.
And it's like, oh my God. And we're having to explain to investors about why we were fundamentally right, but Bear Stearns, and we de-risked as quickly as we could, but we were 3 limits down and blah, blah, blah. We then went on to recover. We made the year back actually in the final quarter when we were short ag markets from a fundamental point of view, and Lehman's blew up.
Yeah. Well, that was the thing, right? I think that summer in '08, everything recovered again and went up higher again.
No, it did. And the theory was that the grain markets went up because they said China's paused for the Olympics. So when they come back after the Olympics, they're going to have to come for the beans and the meal and everything. And actually, we had a couple of channel check guys in the ag space in China in early September phoned us up and said, there's some really screwy stuff going on here. They said the restaurants are not changing their oil out. They're using the old oil. Instead of changing their oil every week, they're making it last a month. And he said, even more worrying, I've just been down in Guangdong and Fujian, and workers are showing up for work, and the Taiwanese factory owners have run away. The Christmas orders haven't come for toys and so on for the US Christmas. And so we we had a fundamental short based actually on the supply side that there'd been big crops in the summer. The North American harvest was going to be big. And then we got this, oh my God, it's not business. China ain't coming back strong after the Olympics. And so we put on a bunch of shorts, and then Lehman blew up in September, and that just accelerated everything. And so we went from up 21%. By the middle of the summer, we were back to flat, and we ended the year up 28%. So we made the year in the final quarter. And so within that year, we had an example of where the fundamentals were completely overturned by the financial markets to the fundamentals being accelerated by the final markets. And the final thing that said to me that it's a whole different world out there is March 09. So if you remember, after Lehman, it took the US, the Congress didn't act quickly. The equity markets continued down. A lot of the ags and soft markets, China stepped in Dec 08. So you'll see in like rubber and corn and so on, the bottom was actually December 08, and the Chinese had stepped in big style to start rescuing the world. For petroleum, China still wasn't a very big importer, and the petroleum markets were really struggling. So Brent had, and WTI were dropping through 40, and we were sat there saying, the market's got to find the price that switches off the North Sea and switches off Russia. And that's probably in the mid-20s. So we're going to stay short crude oil here at $36, $37 a barrel, and we're targeting mid-20s. But to protect ourselves, we're going to bull spread the market, because the market's at quite a big contango, and the time spread has to move before the flat price. So very classical commodity trader thinking that the bull spread's going to protect our flat price short, and we'll get the signal from the tightening of the time curve to lift the short. Bernanke stands up on St. Patrick's Day, and the investment banks by the 5-year.
Yeah.
And so for the first time ever, I think you had a big rally in crude oil led by the back.
Yeah.
And so we get killed on our flat price short, and the market goes to the super contango because the finance is still not available for people to store the oil. And so I think the contango goes to like $3 a month at the front of the curve.
Jesus.
And we're sitting there going, don't these guys, this is not how it's supposed to work.
Man.
And it was actually the options. It wasn't even the futures. It was people buying 5-year call options that drove the whole thing. But actually, when you put on your goggle, change your telescope around, and you're sitting there as a financial markets guy, and it's like, okay, the Fed, don't fight the Fed. So for commodity guys, that wasn't obvious in 08. Because the Fed had very little impact on what was going on in the commodity. The Fed can't grow grain.
Yeah.
What do you mean, don't fight the Fed? That's bullshit. But you put your thing down the other way and you say, well, if the bailout works, the price of oil won't be $30 a barrel in 5 years. Either it fails and it's 10, or it succeeds and it's going back to 100.
Yeah.
And therefore, we'll buy some cheap calls.
Yeah.
As part of our reflation, the Fed's going to save the world package. And that was just like, wow, we're not, it's a different world.
Yeah.
And therefore, so part of the evolution of our market analysis and our risk management systems, as I said before, I coined the phrase, we're not fundamentalists, that we have to take a lot more account than historically we would have done to flow to what's going on in the macro markets. Obviously, we'd always had a big focus on currency markets, but much less on interest rate. Interest rates weren't really viewed as very much of a driver, and particularly for those of us who, in the early years of my career, it's when Volcker put US short-term interest rates to 16%. It's like, again, we just couldn't understand, what's wrong with 5%. Any real-world activity, why do you have to take interest rates to zero? All real activity can perfectly well happen at 5%. The answer is leveraged, highly leveraged bank prop books can't handle 5%. So that was a big learning experience around the integrate, what it meant. And I would summarize it as saying, you could say that its commodity markets became more efficient as you got different players. Traditionally a commodity market was either, so commodity markets were developed to transfer risk. So they developed for hedging. And so through until the mid 2000s, let's say 70% of the activity in the commodity market would be commercial hedging. You'd have the short-term liquidity provided by the pit traders, and then you'd have 20% of the activity with the CTAs and so on. And that obviously was radically changing over that period as commodities became more invested in. And I think generally the physical commodity traders were quite slow to react to that. The other thing that changed was the, if you like, ability to finance positions. So I think you saw it very directly in the cotton market in 2012, I think. But as more financial money came into commodity markets, and at the same time, the banks were tightening up the terms on which they would lend money to the commodity traders, the ability of the physical houses to lean in to a spec-led move has become much reduced. So we actually, in 2011, 2012, we had large trade houses coming to us to pay us to warehouse their futures positions because they couldn't make the margin, that they'd run out of bank lines for margin. And I think you've seen that dynamic has just continued to grow. Particularly in the soft commodity markets, you see traders blown out of their hedges and become very reluctant to fully hedge their book because of that.
Yeah.
So the ability of spec traders to blow the short hedge out the market has changed the dynamics quite dramatically.
Yeah, it's especially if the physical trader is a single commodity player and that market goes crazy. So like at the moment that would be almost recently cocoa traders
cocoa
and
and coffee. Yeah. But even really big guys had to come and warehouse positions with us in.
That's happened in coffee and cocoa the last 18 months. Yeah. So if we move forward to today, I mean, there's some interesting parallels in the sense I'd say there's not a lot of fundamentally based commodity trading talent around.
No.
Some of that's a function of there's a lot of money being made in equities and crypto, and also just there's a lot of the senior traders at trader and then don't retire, right? They hang around till 60 or plus. And so a lot of guys have not moved on, right?
So the volatility of trade, job hogging becomes
has persisted.
Because there's nowhere for them to move.
Yeah. So I think, but to sort of bring it to today,
to a little bit.
Yeah, and the multi-strats. But if you look at sort of the alternative investment space today and specifically commodities, what do you think? I mean, you're not in the hedge fund world anymore, so you're sort of more of an observer than an active participant.
Yeah, so I'm not involved day to day. I'm still actually on the board of the Merchant Commodity Fund, but I don't get involved day to day, that's true. I'm definitely not in the physical markets.
But there's not a lot of independent commodity funds around, certainly of any sort of scale.
No.
Do you think that's going to change, or you think that's a function of the multi-strats, or what's your perspective today?
So I think three things. I think the first thing is we've had this incredible one-way equity market for so long that investors. I think definitely by let's say 2011, you'd reach a period from an investor's point of view. It's why are we even bothering with commodities? So index has been a disaster for us. The CTAs aren't doing very well. And even the brightest discretionary guys have had terrible years. So like we had our worst year was 2011. We lost 30%. We're down 38% peak to trough. And I think investors just sat there, well, we've got this sort of government Fed supported one-way equity market. Why are we trying to make money in this corner of the macro world that is quite obviously really difficult to make money in at the moment, because even the best guys can still deliver you this horrible year. So there was, money flowed away from commodities. We had a bear market, the China bear market from, let's say, 2014 through to 2018, where China's reorienting its growth. And I think to an extent, commodities drifted off the radar of investors. And then secondly, and maybe more importantly, the multi-strats sort of ate the world. The multi-strats managed to convince the large institutions that it's worth paying pass-through pricing because we solve several headaches from you. Instead of having 100 black boxes by investing directly, in your own hedge fund portfolio, you've only got one black box to worry about, which is us. And here's how rigorous our risk system is. A guy's down 2%, we halve his limits, he's down 3%, he has a timeout, he's down 5%, and he's back out on the street. Because the big objection to multi-strats prior to let's say the global financial crisis. So for instance, Amaranth blew up spectacularly because they didn't understand what their nat gas guy, a risk their nat gas guy was running, and just how big his positions were. And so the received wisdom historically was that no multi-strat, you can be good in your core stuff and maybe a little bit of stuff adjacent, but nobody can be good across the whole spectrum of investing. That it just doesn't work like that. And controlling traders, by definition, every trader's a bit of negative optionality. And so the more traders you have, the bigger the risk is that one of them's going to blow up. If you diversify, you just end up with a mediocre basket because the guys who are having a bad year rub out the guys who are having a good year, and therefore multi-strats fell out of favor big time. What Millennium and then Balyasny and Citadel and so on convinced was, you pay us pass-through pricing and we're going to take that money and we're going to get the best talent across the board so that we can credibly guarantee you that wherever the best risk-reward opportunity is at a particular moment in time, we're going to be able to allocate risk to it. And because we have complete visibility and transparency, we can allocate risk in real time. Whereas, let's say the typical terms of a hedge fund is 90-day notice. If you decide you want to reduce equity long short and add commodity, you've got to be looking 4 to 6 months in the future because you've got to redeem from your equity long short guide and by the time you actually get your money to invest, maybe things have changed and so on. And so they offered a better mousetrap to the big institutional world. And we were slow to recognize that those guys are probably never coming back. So logically you might say, well, we're targeting an 8-vol portfolio. We're never going to give a commodity guy more than a couple of percent of our total portfolio. And we want some 20-vol guys in there to, beef up the returns and give you the possibility of our best ever year was 21. We made 75%, 2% allocation making 75% does move the needle.
Yeah.
But in fact, what it means is from a career risk point of view, if you blow up, they've still got to explain. Even though you're only 2% of the portfolio, they've still got to go to the investment committee and say, yeah, well, Mike and Doug, they're good guys. We know them. They've been around forever. There's a great scene, one of my favorite movies, Casino, the gangster movie set in Los Angeles. And at the end of it, it's all going down, and the big bosses are sitting in their meeting, and there's a guy who's like their fixer for the unions. I think Andy Stone was the character, and they're going around the table. Andy, stand-up guy, his dad worked for us, he worked for us, great guy. And it comes to the big boss, and he goes, I say, why take the risk? And the next scene is Andy getting whacked in the car park. And it's sort of the same thing for the single manager fund.
Yeah.
It's particularly a higher vol one. It's why take the risk? And so I don't think nobody has been able, as far as I'm aware, nobody has been able to do what we did post-global financial crisis. So nobody's been able to start with 10 or 20 bucks and get to be a multi-billion dollar fund.
Not for
That
any
world's
period of
gone.
time. Yeah. Yeah, it's gone.
The guy nowadays, the route to launching your own big successful hedge fund is through the multi-strats. So the big $1 billion, $2 billion launches that we see today are guys who've come out of the multi-strats and have the credibility, they get backing from their old shop and they have the credibility with investors that they've come up through that.
Yeah,
Interesting.
there's also the trend where some of the multi-strats are
Well, now they're
effectively
subbing out.
subbing out, seating in an
No, no,
independent
no.
person, even if they haven't come out of the
No, no,
multi-strat itself. Yeah.
that is a new trend. So that's only really started this year. So, for instance, the biggest commodity launch that I'm aware of in many years is an ex Goldman oil trader, Chinese chap, who's got $1 billion ticket from Millennium Day One.
Yeah.
Now, what they're getting are not fully funded $1 billion tickets. What they're getting are
No, exactly
the
right.
the margin on that, but still they're getting fees on a bit, and no doubt the fees certainly won't be 2 and 20, but they're getting that. So yes, and that's probably a sign that we're at peak multi-strat. That maybe multi-strats was a really great offering in the zero interest rate world. So if you just focus on a net, they delivered a net return of high single digit, low double digit with no drawdown, very good Sharpe ratio. In a zero interest world, that was fantastic. 4-5% interest rate world, less good. So I think what's happening, reading between the lines, is that, and it's quite dangerous, it's disguised leverage.
Yeah.
So the multi-strats are giving these tickets out to increase the leverage that they've reached their limit on internally. And it's all about optimizing for Sharpe ratio. But it has led to massively crowded trades.
Yeah.
And so I think there is really is a systemic risk around the huge size that the multi-strats have got to.
Yeah.
Yeah.
Do you think, from an investor perspective, do you think there's a place for active commodity strategies in their overall portfolio?
I think there should be. So commodities is an area where an active manager genuinely adds alpha. So buy and hold doesn't work for commodities. So firstly, you've got the cost of carry, which is negative and high for most things most of the time. And secondly, and periodically people talk about peak oil or peak agricultural land or whatever, but the experience of the last 200 years is falling real commodity prices with periodic short periods of commodity price appreciation. So generally buy and hold kills you other than for short periods of time. Therefore, you need some source of alpha. I think, again, I got cured of my commodity trader anti-systematic bias that whatever it is, it might be voodoo science, but it has actually worked quite well for quite a long time for the guys who do it well. And so your problem as an investor with a systematic strategy is that A, will they let you look at the black box? And B, even if you could look at the black box, can you tell what's a good black box and what isn't a good black box? So there is an element of faith around in the case of a systematic fund, it's around the software or the processes that are under there.
Yeah. I think the other interesting trend as well is the proprietary trading shops that were, say, I suppose started as market makers, let's say, or option market makers, are now setting up
and they're flow.
Discretionary proprietary. Yeah, they're now setting up discretionary proprietary trading businesses on more of our time frame that we used to trade. Yeah.
No, that is so. So again, I think we demonstrated that guys from a physical background with a deep understanding of the commodity, merchant commodity fund is still, its best ever year, and its best 2 consecutive years were 21 and 22. This year they're down a bit, but I think most commodity guys, apart from maybe the metals guys, are having a bit of a tough year this year. So demonstratively, merchant commodity funds been going over, it's in its 22nd year, compounding at 16%. So the right guys can do it. The problem that investors have is there aren't many right guys.
Yeah, I would agree. Yeah, I would agree. Yeah.
And even the rightest guy tends to have some time decay, certainly around relationships. So basically, there aren't many guys my age still in the markets day to day. And so your network is sort of retiring unless you're really good at getting to know the younger generation and keep, make sure you have a spread. You know the guys in their 30s as well as you know the guys in their 50s. But basically, for most, your problem as an investor with a discretionary manager is your assessment is that has to be on the manager. And in
Yeah.
particular, is his edge eroding? Is he still hungry? Has he got a bit lazy? Is he distracted? He's not fully on it anymore. And I think generally, and maybe it's probably to do with the way the world's changed generally, that younger allocators certainly are more comfortable with a process that's systematic rather than having to make a judgment call on a guy who's maybe a generation older than they are. So I think I think there should be still room. Actually, when you look around the hedge fund world, there are loads of great great managers with AUM that isn't congruent. So there is
Yeah.
definitely a fashion in allocation. My working analogy for many years has been the pop music business. That for most bands or singers, they have a moment in time where the record company thinks that that's going to be the sound of this summer or the next couple of years. There are very few who last, multi-decade. Yeah, you've got the Rolling Stones and so on, but they're as a percentage of the number of bands. One of the funniest conversations I had, so over the years, so Jeff Curry, who was the chief economist at Goldman, at J. Aaron and Goldman Sachs, I think he's now at Carlyle. So interesting that a private equity business sees fit to have a very experienced commodity fundamental analyst on their team. Anyhow, over the years, Jeff and I appeared on different platforms at different times. And the last time I think that we were on the same platform, it was at the Goldman Sachs macro event, probably I think 2017 in Hong Kong. And we're sat in the green room, and Jeff says to me, he says, "Look at this, Mike." He says, "A few years ago, we were opening the conference. We were like, they wanted the commodity guys up there on the first morning session. They'd have a panel on, China, is oil going to 300 or whatever." He says, "Now we were on like the last slot of the last day." He said, "We're now on, the graveyard shift." He said, "We've gone from playing stadiums to being wedding singers." But the
Yeah.
reality is you've actually become a better musician.
Yeah.
You've learnt your lessons on risk management, on the investment process. You've stood the test of time, but, fads and fashions, you
Yeah.
know, the number of times I bump into guys these days at conferences where I say, "Oh, I didn't know Merchant was still going. Is Doug still, because my partner, Doug King, is very much, and so but they want to chase the latest spin out from a multi-strat or whatever. But I think the acid test, and I often say it to guys who are coming outside in the hedge fund. A lot of guys, again, it's like if you think of a sports analogy, a mediocre player can look good in a great team. And so if you have a seat on a desk at Cargill or in at Goldman Sachs or whatever, and it's human nature that you undervalue the value of the seat and overvalue yourself.
Totally. Yeah.
The acid test is when you come out to set up your hedge fund and there's one or two of you, a Bloomberg and a blank piece of paper, no flow. Can you do it?
Yeah.
So,
Yeah.
so,
It's a
so, so,
challenge.
so in this world, and so even in the world of a commodity, if you take, there's 10 guys come off the training program this year at Cargill, let's say. Out of those 10, probably all 10 could become pretty competent analysts. They can do a good S&D, build the models, so on and so forth. Maybe only 4 could be competent supply traders, or they can either originate or sell to the airlines or whatever. Maybe only one can actually run a book.
Yeah.
So
It's a unique skill, right? I
it's a
think, 'cause
very so trading is easy to do. You know, you can press the button these days on your computer and buy and sell 10 lots or 20 lots. It's really, really hard to do it well year in, year out for
Yeah.
many, many years. And so they are quite rare talent. So, you know, the guys who can. And then I think it's like a Sun Tzu saying, you know, the Chinese art of war, that because a man can command a regiment doesn't mean he can command a division. And if he can command a division doesn't mean he can command an army. So most people have some natural, you know, you get freaked out at $100, so you get freaked out at 1 billion, or you get freaked out at 5 billion. For most people have a sort of psychological ceiling around how much risk you're comfortable with or you can cope with. But there are some guys where that tolerance is very high.
Yeah.
And of that small subset, there's an even smaller subset who are willing to submit to the discipline of rigorous risk management to,
Yeah.
you know, put the
The
safety
Venn
net there.
diagram's not often very big.
No, it's a very, very small. And so I think certainly sophisticated professional investors are really conscious of that when it comes to allocating to single managers.
Yeah.
That lots of guys can sound good, talk good, but do they have proper longevity and scalability? And therefore, they're naturally pretty reluctant to do that. But I would say it's almost impossible to start from a small seed anymore. You've either got to go to a commercial seed who'll give you a couple of hundred, or be coming out of a big multi-strat.
Yeah, I'd agree. Just a couple of questions before we finish up.
Yeah.
So I think one for the younger listeners in the audience. I mean, what do you think is unique about commodity markets versus the other, you know, more traditional equity markets, bond markets? You know, what's attractive to you?
So I think you find it's a fairly common theme, you know, whenever I talk with, you know, my peers and guys and so on. Why did we choose commodities over the? And I think for most of us, it comes down to the tangibility, that they're real things and some element of romance. So certainly in my case, my route to commodities came through geography, economic geography, when I was at high school. And as part of our course, we did, you know, the development of the rubber industry in Malaya, the Midwest corn belt in America and so on. And there's that sort of romance, the history, you know, because commodities were so fundamental in creating the modern world, you know, all the ills of colonialism. But, you know, at the end of the day, that's, you know, why did the Spanish take coffee to South America? Why did the British take cotton to the southern states of the US? Why did the British smuggle rubber seeds out of Brazil into originally Southwest India, then Malaya, where it was all about economics and so on. So I think for some people that resonates in the way that a bond or an equity doesn't really. The tangibility, and then I think certainly most of us from a physical background, we really enjoyed, you know, going down to a rubber factory in Hadjai and, you know, drinking shots with local Chinese traders and, you know, going out to Akron and drinking shots with the Goodyear's buyers and that sort of real world, you know, there's that gritty element where you're down there in the physical supply chain handling the real stuff.
Yeah.
And I think to me, that's a common thread. Generally, most commodity guys, certainly when they were younger, you know, you like going out into the more remote places and that sort of sense of adventure. That continuity, you know, Cargill actually doesn't call you a trader, you're called a merchant. And that sort of identification with the merchant adventurers of the 16th century or whatever, that you're a continuation of that line with the bad stuff taken away in what your merchandise, in what your
Exactly.
opium.
No, exactly. All right. Well, I think that's a great place to finish up, Mike. Yeah. I just want to thank you very much for your time, and it's been great getting your background and understanding more about your history and your perspective on commodities and investing in commodities. And yeah.
I hope you enjoyed this episode of the GSX podcast.
You can find out more about GSX at greatsouthernx.com and follow us on X at GSX Commodities. You can also follow me, Henry Walsh, at H2Walsh. Until next time.